When a stock just absolutely plummets overnight, it's super easy to point fingers at the broader market, right? Maybe blame a sudden product failure or, I don't know, a global supply chain crisis. But if you actually sit down and talk to institutional investors, they're going to tell you a completely different story. They'll tell you the real breakdown happened months earlier, and it happened right behind closed doors, inside the boardroom. Welcome to this explainer. Today we're decoding India's 2026 corporate boardroom reality. We're going to look at exactly how things like true independence, executive pay, diversity, and data privacy have completely transformed the G in ESG into a massive active valuation multiplier.
So, here's our roadmap for today. We'll start with the governance valuation multiplier, then dive into pay versus performance scrutiny. After that, we're shifting beyond token diversity, exploring board-level data governance, future-proofing boardroom governance, and then we'll wrap things up in our outro. Let's get right into it.
Section 1. The Governance Valuation Multiplier. There's this old fundamental saying in finance, right? Capital goes where it feels safe, period. And today, both domestic and foreign institutional asset managers are getting incredibly aggressive about scrutinizing internal boardroom mechanics before they even think about making an investment. They aren't just glancing at quarterly earnings anymore. No, they are deeply analyzing the very structure of the board that actually signs off on those earnings. Now, the empirical data we're seeing in recent market studies is just fascinating. The old view kind of treated ESG as this, philosophical or ethical debate. But the 2026 reality, it's driven purely by hard numbers. When you look at analyses of BSE 500 companies, they clearly revealed that high environmental and governance scores directly minimize agency costs and absolutely boost long-term profitability. While the social aspect might sometimes bring short-term costs, strong E and G metrics show a massive positive correlation with higher return on assets and profit after tax. So simply put, good governance literally pays off.
Moving on to Section 2, pay versus performance scrutiny.
Okay, get this. According to the latest Deloitte India survey, the median compensation for a professional, non-promoter CEO in India currently stands at a staggering 10.5 crore rupees. But here's the catch. That is actually only a 5% year-on-year increase. See, for years, promoter-led or family-owned businesses could just scale salaries up completely unchallenged. Well, not anymore. Proxy advisory firms and massive institutional domestic funds, we're talking mutual funds and LIC, they are pushing back hard. They're looking at flat stock valuations and demanding that executive pay transparently aligns with actual operating performance.
You can really see this play out when you look at how remuneration committees are totally shifting their strategies across the C-suite. CEOs are actually moving away from those traditional stock options, shifting toward really complex multi-year performance plans that are heavily linked to capital efficiency and ESG targets. Meanwhile, CFOs, they are seeing massive compensation growth, hitting a median of 4.5 crore rupees. Why? Because of the intense regulatory liability they face, and independent directors at Nifty 50 companies, their median pay has crossed 3 crore rupees purely to handle the heavy statutory mandates they now have to shoulder.
So the really crucial takeaway here is how risk is actively being priced inside the boardroom. Audit committee chairs at large-cap firms routinely command a massive 25 to 35% premium over standard independent director pay. And honestly, it makes total sense. They carry the immense legal liability of signing off on highly complex ESG requirements, like the BRSR core framework, alongside all the standard financial disclosures. When regulatory fines and even clawbacks from the NCLT are literally on the table, that 35% premium, it's essentially hazard pay for corporate oversight.
All right, Section 3, shifting beyond token diversity.
So Indian corporate law does require top-listed entities to have at least one independent woman director. But here's the thing. Sophisticated investors fully realize that just checking a legal compliance box absolutely does not equal good governance. They're actively analyzing whether this diversity actually extends into real execution roles, like managing business units or running operations on the ground. They want boards with genuinely varied professional backgrounds and true oversight authority, because a diverse board naturally prevents groupthink and significantly reduces operational blind spots.
And that actually brings us to a really fascinating 2026 debate regarding the true boundaries of independence.
Recently, SEBI issued informal guidance in the Mythen Alloys case that allowed a promoter's cousin to serve as an independent director. Now, by the strict technical letter of the law, a cousin isn't classified as a statutory relative. But institutional funds look at that and see a massive red flag. I mean, think about it. How objective can a director truly be when they're evaluating the pay and performance of their own cousin? Investors are increasingly voting against these types of appointments, completely regardless of the legal technicalities.
Up next, Section 4, Board-Level Data Governance.
With the DPDP Act now fully operational, data security is no longer just an isolated IT issue for the engineering team down in the basement. Not at all. It is now an active, existential board-level compliance liability. Institutional investors are actively screening for boards that feature dedicated cybersecurity subcommittees and run rigorous, periodic data risk audits. Basically, every single instance of personal data processing, cross-border data transfer, or even a potential algorithmic leak has to be overseen by the absolute highest levels of corporate leadership.
And the financial stakes here are frankly staggering. A failure to implement reasonable security safeguards can result in catastrophic statutory fines. We are talking up to 250 crore rupees per individual violation. The DPDP Act literally introduces data protection as a fiduciary obligation. So a major data breach doesn't just destroy consumer trust anymore, it can fundamentally threaten the entire company's balance sheet.
Because this risk is so incredibly severe, the role of the company secretary has expanded dramatically. Honestly, it's a huge shift. They are essentially being elevated to the role of data governance officer. They're now the crucial bridge between the boardroom's strict legal obligations, the technical infrastructure managed by the engineers, and the ultimate accountability to the stakeholders. It's their job to ensure that data protection risks are directly integrated into the company's enterprise risk management framework.
Which leads us to Section 5, Future-Proofing Boardroom Governance.
So how do you actually adapt to all this intense scrutiny? Well, here is a very concrete, actionable playbook for future-proofing your company. Step 1. You have to link executive pay to long-term ESG KPIs. Tie a defined percentage of executive bonuses directly to verifiable metrics like zero-incident workplace safety or strict data privacy compliance. Step 2. Formalize your succession planning and regularly rotate your committee chairs to keep oversight fresh and sharp. And Step 3. Establish a dedicated risk and tech committee. You absolutely need to ensure your board has at least one independent member with deep technical expertise to supervise AI and data risks safely.
Finally, Section 6, our outro.
Look, you can have the most innovative product or literally the most environmentally friendly factory in the entire world, but it can all stall in an instant if your corporate governance is fragile. Remember our golden rule for today's market? Capital goes where it feels safe. A diverse, fiercely independent, and highly tech-aware board isn't just about ticking boxes for regulatory compliance anymore. It is the ultimate competitive advantage.
I am really curious to hear your perspective on all of this. How closely do you look at a company's boardroom independent oversight before investing your money? Do familial ties on a board bother you, or do you look past them? I'd love to chat about board diversity and corporate governance trends in the comments below, so definitely drop your thoughts there. And hey, if you found this explainer valuable, please make sure to subscribe, hit that like button, and share this with the founders, corporate secretaries, and finance professionals across your network. Thanks so much for tuning in, and keep learning.